Ladies and gentlemen, good day and welcome to the General Insurance Corporation of India Q3 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Binay Sarda from Ernst & Young. Thank you, and over to you, sir.
Thanks, Myron. Good afternoon to all the participants on the call, and thanks for joining this Q3 FY23 earnings call for General Insurance Corporation of India. Please note that we have mailed out the press release to everyone, and you can also see the results on our website as well as it has been uploaded on the stock exchanges. In case if you have not received the same, you can write to us and we will be happy to send it over to you. Before we proceed with the call, let me remind you that the discussion may contain forward-looking statements that may involve known or unknown risks, uncertainties, and other factors. It must be viewed in conjunction with our businesses that could cause future result performance or achievement to differ significantly from what is expressed or implied by such forward-looking statements. To take us through the results of this quarter and answer our questions, we have with us the management of GIC represented by Mr. Devesh Srivastava, Chairman and Managing Director, and other top members of the management. We'll be starting the call with a brief overview of the quarter gone past, and then we'll follow it up with a Q&A session. With that said, I'll now hand over the call to Mr. Devesh Srivastava. Over to you, sir.
Sure. Thank you, Binayji. Good afternoon, everyone. I'm pleased to announce the financial performance for the quarter ended December 31st, 2022. Before discussing the results, I would like to thank all our shareholders for having faith in our underwriting capabilities and for patiently supporting us during the hard times. Over the past few years, we have continued to refine our approach and become more selective with a sole focus on underwriting profitability. We have witnessed hardening of rates, which has further helped us get our act together and focus on improving our performance at the underwriting level. Let me now take you through some of the key highlights of the financial performance. The gross premium income of the company was rupees 10,099.40 crores for Q3 FY23 as compared to rupees 10,240 crores for Q3 FY22. The investment income has increased to rupees 3,025.66 crores in Q3 FY23 as compared to rupees 2,271.14 crores in Q3 FY22. The incurred claims ratio declined to 96.9% in Q3 FY23 as compared to 121.9% in Q3 FY22. Combined ratio in Q3 FY23 stood at 114.74% versus 126.54% in Q3 FY22. The adjusted combined ratio, by taking into consideration the policyholder's investment income, works out to 93.63% for the 9 months of FY23 as compared to 104.62% for the 9 months FY22. Profit before tax stood at 1,595.79 crores in Q3 FY23 as against loss before tax of rupees 101.67 crores in Q3 FY22, and profit after tax stood at rupees 1,200.71 crores in Q3 FY23 as against the net loss of rupees 28.48 crores in Q3 FY22. Solvency ratio increased to 2.38 as on 31/12/2022 as compared to 2.25 as on 30th September 2022. Net worth of the company without fair value change account increased to rupees 27,822.39 crores as on 31/12/22 as against rupees 22,605 crores as on 31/12/2021. Net worth of the company, including fair value change account, increased to rupees 61,616.80 crores as on 31/12/2022 as against 53,723 crores as on 31/12/2021. On the premium breakup, domestic premium for the 9 months of financial year 23 is rupees 20,662.02 crores and the international is rupees 8,559.83 crores. The percentage split is domestic 71% and international 21%. There is a degrowth in the domestic premium by 8%, while the international book has decreased by 18%. We continue to work tirelessly towards a well thought out strategy to get as close to 100% in combined ratio in the shortest possible time, and we are seeing our efforts paying dividends. It has been a relentless focus to make our portfolio healthier and emerge as a much better and profitable reinsurer over the long term. We are actively monitoring the competitive dynamics in the domestic and international market and accordingly formulating our response on a continuous basis. We remain optimistic and are fairly confident of improved performance going forward. Having given the highlights, we will now open the floor for questions from the interested parties. Thank you.
Thank you. We will now begin the question and answer session. Participants who wish to ask a question may press star and one on your touchtone telephone. Anyone who wishes to remove yourself from the queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have the first question from the line of Saket Gora from Spark Capital. Please go ahead.
Yeah, thank you. Thank you for the opportunity. Sir, if you look at the combined ratio breakup of 115, we believe the domestic business has turned around with a combined less than 100 for 9 months of FY23. While overseas business remains the drag on the entire combined. So if you can give us a color, what led to that elevated combined in case of overseas business? Because that number, if I see, is even higher compared to what it was in 1H FY23. So and what led to the improvement in the domestic combined ratio? That was my first question.
Saket, you are absolutely spot on when you say that the combined for the domestic is for the 9-month period down to 99, which is of course a very gratifying factor for us. But yes, foreign is still high, and because the foreign business has been so globally, that is exactly the reason why you are seeing a hardening of rates. I would request Mr. Joshi, our General Manager looking after reinsurance, to pick it up from here, please.
So as you observed that as we discussed earlier that there is a degrowth in the foreign which is much more than the domestic.
Yeah.
So and as sir mentioned just now that there is a meaningful and very actually quite significant hardening of the international property reinsurance pricing. So we can expect a very good improvement in the foreign going forward. And as sir said, it is a market-wide phenomenon during last 5 years, which is culminating in a very significant hardening. The hardening which is the entire insurance market globally has not seen in last 3 decades. It is such a severe reaction of the pricing correction.
So January renewals, according to you, what is the extent of price hardening you have seen, sir?
Again, as we have discussed earlier in various such calls, that it will be difficult to paint a broad diverse picture, but different geographies have different hardening trends. Say, for example, Asia Pac is seeing something like say 20 to 50%. Say US is seeing something like say 30 to maybe 100% plus. So, and again, within these broad ranges of hardening, there is a differentiation between at what layer, whether it is a bottom layer or a top layer, whether the program has seen losses, whether the expiring price is adequate, what is the composition of peril, what is the restructuring in the program. So there are various aspects to the changes in rate and hardening. But very broadly speaking, the Asia Pac would be say 20 to 40 to 50%, depending on the particular account and the history of the account and geography involved.
But sir, this hardening, as you said, given we are almost 150 combined in overseas business in the current 9 months, So this hardening should be good enough, assuming the same amount of cat events happen and all those things. Should bring back the overseas book next year to closer to the domestic numbers, or you still believe there is some inadequacy in the price hike?
I think it will not be correct to speculate right now as to where we will land in terms of the combined ratio. But the kind of say broad consensus and view which is emerging in the reinsurance market is that this hardening is going to sustain for at least a couple of more years. So if there is still felt that there is a price inadequacy, I think market will continue to correct. But on the flip side, since there is an interest rate hardening, maybe the better investment income for the Western reinsurance players will kick in. So we will need to wait how this dynamics of the price improvement and the investment income will play out.
So if the price hardening is there and if volumes don't correct, if number of contracts what you do don't correct, then we can see the overseas business growth to pick up substantially in next year, because it is minus 18% as you said in the current year. Can it become meaningfully positive with the price hardening?
Sorry, I didn't get the last sentence.
Sir, what I was trying to say is that in current year, till 9 months FY23, we are minus 18% in the overseas business, right? So with the kind of price hardening you are seeing, the possibility of growth to happen only because of the price hike, assuming we do the same amount of contracts next year also, then we can say a significant positive growth to happen in next year only because of the price hike for overseas business?
Yes, I would say that we can expect that.
Okay. So a mid-teen kind of a growth is very much possible, sir, in overseas business?
Sorry?
A mid-teen, maybe a 12 to 15% kind of a growth is very much possible in FY24 for the overseas business, foreign business?
See, Saket, growth is not the issue. I mean, you can grow in any market. Reinsurers never have a problem with growth. The whole idea is to be profitable. And you have to find your way through.
My question was, sir, more just because of the price hike, that growth could be in mid-teen. Assuming you have been prudent for a while now with respect to contract selection. If you maintain the prudence, I'm assuming you will maintain so, then the price hike itself should drive the growth to maybe minus 18 to plus 5, 10, 15% kind of a number for next year.
Yes, Saket, certainly. The risk-adjusted rate change is substantial. There's no doubt about it. So what you're saying appears very plausible.
Got it, sir. Got it. And domestic business correction, what you have seen, 8% is largely because of the obligatory part or obligatory part and the crop part, or something else also has seen a slowdown in that sense?
I think it is more across the board, and now increasingly our approach is bottom up. So we are looking at each individual contract in terms of price adequacy. So it is not specific to a particular contract. I think as far as crop is concerned, we did a degrowth and pruning during last 2-3 years. Of course, this current year was one more year, but then it is more bottom up. So it is to varying degree for various crops.
Got it, sir. Got it. And anything you have heard from the IRDA incrementally, what they are going to do with the or their approach to the obligatory part? The 5 has got reduced to 4. Whether it will further come down next year, or this 4% is going to remain for a couple of years and then gradually reduce to 3, 2, and 1?
Saket, we have only statistics to say, you know that it used to be 20% once upon a time. Then it came down to 15 to 10 to 5, and it has been 4 even last year. No, it was 5 last year, reduced to 4 last year, and it has continued to 4 this year. So the trend, the insurance regulations clearly state that the main objective of the reinsurance regulations is to retain premium in the country as far as possible. So we only have to wait. This is something of a decision that is taken at the highest level. It will be difficult for us to, speculate and say something with any amount of certainty.
Got it, sir. My intention was to ask whether a dialogue has started and any communication you have to convey to us whether this number is going to come off in near future or not. That's the only reason I was asking. But okay, sir, I understand.
It's always year to year. So what the notification that has come out right now is for the year to go. And it's always a year to year notification.
Right, sir. Right. I completely agree. See, this 98 point or 99 combined, what you have reported for the domestic business, despite obligatory coming off, means any reason you contribute to it's largely because of the declining crop or a price hardening environment that to some extent is visible in the domestic business, especially in the commercial line?
Saket, I would say it was a culmination of a lot of factors. You see, crop was one, IIB rates that we had put in is another. Also the fact that we have been looking at businesses with a very keen eye. So it has been a culmination of a lot of factors, and the entire management has worked towards this. This is the result of that.
Got it, sir.
Able to ascribe it to a certain single source.
Got it, sir. And last two data keeping questions. One just wanted to understand why tax rate around 7% is lower in the current quarter. And the next question is if you can break down your investment income, which is around 2,600 crores in the current quarter, broken down into capital gains and the dividend income and the interest income.
Tax rate, and Jayashree already here.
Yes, ma'am.
Yeah. Tax rate is actually we have opted for a lesser tax rate regime, 22%, and hence the tax impact is lesser this time. Also, we have got some credit for last year's dividend which we paid in our provision for taxation. That is also impacted around 134 crores. So this is why the tax impact has come down in this quarter.
So going ahead, we can safely assume that your marginal tax rate will be 25% except for that one-off of dividend income you got. Right, sir? No?
Certainly, yes. Going forward, it will be somewhat in the range of 25% of.
Got it. And investment income, you can break it down, ma'am, 2,600 into capital gains, interest income, and dividend income.
Yes, sir. This is Radhika Ravishekar, the CIO.
Yeah.
The breakup of that income will be interest is around 1172.29 crores. Dividend is around 91. And the balance is from profit on sale of investments. That is 1217.29 crores. So the breakup of 2,480.
Okay, ma'am. Perfect. Thank you very much. That's it from me.
Thank you. Participants who wish to ask a question may press star and 1 on your touchtone telephone. Participants who wish to ask a question may press star and 1 on your touchtone telephone. We have the next question on the line of Kailash Baheti, an individual investor. Please go ahead.
Hello?
Mr. Kailash, you may go ahead with your question.
Yeah, my question is, number one, there is this AM-based report, there is a qualification, refers to a qualification with reference to certain reconciliations have those been completed in receivables, payables, or these are still there and will qualify as enterprise risk?
Mr. Baheti, our CFO will answer that again.
Yeah. So, Mr. Baheti, this quarter's audit report, we actually with this qualification regarding the concerns of reconciliations and confirmations, we have initiated a system now in GIC, which we also advise AM-based also auditors, along with concurrence of auditors. This system is there where the confirmations are inserted in our computerized system. So with that, last 2 quarters, most of the confirmations have been received and the balances are confirmed. So this quarterly report, if you see, the qualification has been removed by the auditor and now it is emphasis of matter, and we will try and reconcile the balance 10-20% also in the next quarter, and this comment will go off. So the qualification is already removed this quarter.
Okay, that's great. Just to understand, even the AM Best also has said that your enterprise risk management is still evolving, and which means that it is not strong enough according to them. When are you doing something to improve there, and therefore, say by end of the year, say that you have a robust risk management system, even according to AM Best standards?
Mr. Baheti, in fact, this is one area where we have given AM Best a push already. Earlier, when we had an A rating, the ERM system was found to be absolutely suitable, and that is why that rating was there. Now, you can't call it at a later date that it is still evolving. So that was a wrong nomenclature to have been used by AM Best. But be that as it may, there have been substantial work that has been done on the ERM because it's a continuous process. And not only for AM Best, but for the corporation as a whole. We do believe that the ERM systems here should be robust. We have gone ahead, in fact, even made out a capital management plan, which is something that would be, important for the corporation going forward. So it's an ongoing process and it's on.
Mm-hmm. Okay, my next, this can be a suggestion or a question, is that usually the investor presentation, which is circulated by the companies, is given along with the results, and that is across the board. Except in your case, probably the investor presentation is put up later. And number two, the investor presentation is also not very exhaustive, very informative, and has a pattern which is there for many years. It would be good for the image of a company if the investor presentation quality improves and it is also circulated along with the results. Because later on people, I mean that's the time when people look at the investor presentation. Later on it actually loses its relevance.
Mr. Baheti, that point is, and that suggestion is very well taken. Thank you for that. We will definitely take care of it.
And while you said that in reinsurance growth is not a problem, at the same time the investors look at growth in a company. So is it that you are not getting good enough businesses which are profit making and therefore degrowth? Not that I am complaining about the company turning stellar profitability, but growth is also important. So when do you expect to return to growth? When do you expect us, which is profitable, to return to growth?
Right. So, Mr. Baheti, most certainly, see, the whole idea was of consolidation because we had, expanded quite a bit, and it was important for us that going forward, our systems, our processes should be set in place so that whatever we write is something that we take informed decisions about. And that is why we have taken this. A great amount of pruning that had to be done has been done. I would say that we have almost reached an inflection point now. And now going forward, you will see growth but with profitability. That is going to be the essential difference. And profitability will be the key, but yes, I do agree that growth is something that you can't, wish away. That is life. Growth is life.
Mm-hmm. And this year, maybe your ROE will touch maybe close to 20% or higher, maybe higher. Do you expect that you have a minimum, threshold on ROE, which will be your object every year, year after year, so that the consistency brings desired value for the shareholders?
I mean, Mr. Baheti, yes, definitely we would want, that consistency to be that is part of our business. A reinsurer basically does what? It provides consistency to the operations of an insurance company, thereby to the insured, therefore to the commerce of the entire country, in fact. Reinsurers are the ones who actually believe in getting that, evening out the crests and troughs. Similarly, we would also want that consistency to be there and be there for the long term because our business is long term. So while we wouldn't really want to put a figure to it, but yes, consistency is what is always going to be the hallmark of a reinsurer, and that includes GIC as well.
Great, thank you. That's all I have.
Thank you, Mr. Baheti.
Thank you. Participants who wish to ask a question may press star and one on your touchtone telephone. Participants who wish to ask a question may press star and one on your touchtone telephone. We have the next question from the line of Deepak Sonawani from Haitong Securities. Please go ahead.
Hello, sir. Am I audible?
Yes, you are.
Yeah. Thank you for the opportunity, sir. So my first question is regarding our motor insurance combined ratio for a foreign portfolio. It has been, this very huge amount of deterioration over the last few quarters, right? Even in 9 months as well, it has gone to 149% as of from 128% from last year. So, and we have been taken a stance that we are coming out of some kind of geographies, right? Few quarters back, you gave, during the call you gave such kind of information, but still our combined ratio is really high. So, any reason for that?
As I said that we have this treaties and contracts which tend to have a kind of tail, which we call internally in our industry. So when a contract is discontinued, you still continue to have the financial implications of those contracts for, say, something like 4 to 8 quarters. So I think this should taper off maybe more steeply than can be otherwise expected. So whatever business needed to be discontinued is discontinued. But then it still has a certain lingering effect. So what we are seeing is certainly lingering effect of the discontinued business.
Okay. And that this effect, you expect this to be continued over the last, how many quarters?
That is not an easy one to say because it depends on how the underlying losses behave and develop in a given geography. But it will be sticking my neck out, but probably it can be for at the most around 2 quarters, if at all.
Okay. And we are sure that we have fully come out of this kind of, the loss-making portfolios, right?
Almost.
Okay. And if you can give us breakup for foreign portfolio, we have reported around 8,600 crore foreign GWP. If you can have breakup between these major lines, that will be really helpful.
It is there in the press release, I believe.
Mr. Sonawani, you're looking at the major components, right?
Yeah, major components. It is not the, I checked the presentation, so
Okay.
they are given in claims incurred and combined ratio, but certainly not the GWP. I'm asking for international business only, and not for domestic.
Right. So the big one would be fire is 4,786 crores.
Okay.
Motor is 1,723 crores.
Okay.
Aviation is 611.
Okay.
What else would be? Marine hull is 256 crores.
Okay.
Those are the big ones.
Okay. Thank you. And so my last question is on agri book. So we are been pruning this book last 2 years, if I'm not wrong. So what is the next phase of, what is the strategy for our next phase of growth in agri?
I think we have de-grown enough, and I think we are very happy with where we stand today. So any growth will be based on the efforts and opportunities that we believe will be price adequate and which will contribute to our profitability and the return on equity.
Okay. So that means you'll be remain selective, right? Selective in terms of geography and selective in terms of profile, right?
Absolutely.
Okay. Thanks a lot.
Thank you. We have the next question from the line of Malhar Ravalia, an individual investor. Please go ahead.
Hi, guys. Thank you for the opportunity. Just given how the business has turned the corner, and you're pointing to greater profitability ahead, do you want to comment on the outlook for dividends and or other capital management that could be undertaken to unlock some shareholder value? Thank you.
Malhar, this would be, I think, difficult to comment on right now because we are a government company. There are certain guidelines there. But let's see. Most certainly, we do have our investors in mind paramount.
Thank you.
Thank you. Participants who wish to ask a question may press star and one on your touchtone telephone. Participants who wish to ask a question may press star and one on your touchtone telephone. We have the next question on the line of Kailash Baheti, an individual investor. Please go ahead.
Yeah, my follow-on question is on the debt portfolio, which is not fair valued. Are we sitting on a gain or loss and the amount thereof?
So this is CIO Radhika Ravishekar again. Our debt portfolio, as you know, is basically held to maturity. So it will be basic on the yield one. What the benefit you get is on the yield, which has shown a massive improvement.
Okay. What would be the yield right now on your portfolio?
Yield on my portfolio will be around 7.50, sir. So everything put together, that is CGS, SGS, corporate debentures, everything. The entire fixed income category. It is around 7.53.
Sorry?
7.53, sir, percentage. That is the yield.
10.53 is the yield. Okay. Thank you.
Thank you. Participants who wish to ask a question may press star and one on your touchtone telephone. Participants who wish to ask a question may press star and one on your touchtone telephone. As we have no further questions, we would now like to hand it over to the management for closing comments.
Thanks again for the interest that you've shown in the corporation. We have, steadily progressed, and that progress will continue in the coming years as well. And GIC will emerge as a much stronger, much more resilient, and a much stable reinsurer than before. And that is the whole game plan going forward. So thanks again for your time today. Good afternoon.
Thank you. On behalf of General Insurance Corporation of India, that concludes this conference. Thank you for joining us, and you may now disconnect.